Hello everyone. Good morning and welcome to AAA Revision Revolution. Yesterday we stopped at question 2A part. We're going to continue that. See, now I have already given you the answer of the first question in very much detail. Okay, but if we do every question in detail, the time will not allow us to do a mock after that. So what I'll do is I'll give you the main pointers and then you have to twist and turn it and write it down in your own words. Okay? So I'll just share the screen with you. This is the second question that we have. Goodman Group, out of which the A part has been solved by us. This is the A part, which is worth 6 marks. Discuss the implications of the fraud for the completion of the audit and the actions taken by the auditor. This is using the information contained in Exhibit 1. Now next, again using Exhibit 1 only, this is the continuation of that, which is for 11 marks, both of this. In respect of the development cost and trade receivables, comment on the sufficiency and appropriateness of the audit evidence obtained. We've already studied sufficiency and appropriateness of audit evidence, so you have to comment on the sufficiency and appropriateness of the audit evidence and recommend the actions to be taken by the auditor, including the further evidence which should be obtained. So let's look at Exhibit 1 again. And this is using the Exhibit 2. Okay, so let's look at Exhibit 1 again. For sufficiency and appropriateness of audit evidence obtained. Let's read the entire Exhibit 1. First one, it is 1 July 20x5. You work in the audit department of Saul and Company. The Goodman Group, the group is an audit client of your firm, and the audit for the financial year ended 31 December 20x4 is in the completion stage. The group, which is not listed, installs and maintains security systems for businesses and residential customers. Materiality for the audit of the group financial statement has been determined to be $4 lakh. The following exhibits available below provide relevant information to the question. So Exhibit 1 is the completion matter details regarding issues you have discovered during the review of the audit working papers, and Exhibit 2 is the draft auditor's report and supplementary information. So the Exhibit 1 says, fraud. The group finance director has informed the audit team that during the year a fraud was carried out by a manager, Mike Trout, in one of the group's procurement departments. The manager had raised fictitious supplier invoices and paid the invoiced amounts into his personal bank account. When questioned by the group's finance director, Mike Trout confessed that he had stolen $40,000 from the group. The finance director asked the audit team not to perform any procedures in relation to the fraud, as the amount is immaterial. He also stated that the financial statement would not be adjusted in relation to the fraud. So regarding the fraud, we have already answered the A part of the question, which is this. And the two courses of action, first and second. So this has already been done. Okay. The only audit evidence on file is a written representation from management acknowledging the existence of the fraud and a list of fictitious invoices which had been raised by the manager provided by the finance director. The audit working papers conclude that the fraud is immaterial and no further work is needed. Development cost. In August 20x4, the group commenced development of a new security system and incurred expenditure of $6 lakh up to the financial year end, which has been capitalized as an intangible non-current asset. The only audit evidence obtained in relation to this balance is as follows. Arrangement of a sample of the cost included in the $6 lakh capitalized to supporting documentation such as supplier invoices. Cash flow projection for the project, which indicates that a positive cash flow will be generated by 20x8. The projection has been arithmetically checked. A written representation from management stating that management considers the development of this new product will be successful. You're aware that when the group finance director was asked about the cash flow projections which he had prepared, he was reluctant to answer questions, simply saying that the assumptions underlying the projection have been agreed to assumptions contained in the group business plan. He provided a spreadsheet showing the projection, but the underlying information could not be assessed as the file was password protected and the group finance director would not provide the password to the audit team. Trade receivables recognized in the group's current assets includes a balance of $5 lakh relating to a specific customer, Hamlin Company. Audit procedures indicate that at 31 December 2024, the balance was more than 6 months overdue for payment. In relation to this balance, the following procedures have been performed. Agreement of the balance to invoices and original customer order. Discussion with the group credit controller who states that we are in discussion with Hamlin Company and we are confident that some or all of the amounts due to us will be paid. We have also allowed this customer extend credit terms and they have always paid eventually. Hamlin Company was included in the trade receivables direct confirmation audit procedures, whereby a sample of customers were asked to confirm the outstanding balance, but no reply was received. So this is the draft 1, and from that we have to state and comment on the sufficiency and appropriateness of the audit evidence that is obtained and recommend the actions to be taken by the auditor, including the further evidence which should be obtained. So is the evidence that is currently obtained is sufficient and appropriate, and what else needs to be done? So this is 1, 2. Okay, regarding the sufficiency and appropriateness of the audit evidence obtained. So let's proceed with that. So 2 and 3 will answer together because it's together for 11 marks. So first talk about audit evidence of development cost. Then talk about trade receivables. So audit evidence development cost. Okay. Given that the development cost are material to the group financial statement, more audit work should be carried out to determine whether it is acceptable that all or some of the $6 lakh should have been capitalized. Okay, then what else? There is a risk that research cost which must be expense have not been distinguished from development cost. Which can only be capitalized when certain criteria have been met. Okay, so what is the third point you can write? currently there is not sufficient appropriate audit evidence to conclude that the accounting treatment is appropriate and intangible assets could be materially misstated. Okay. Then what else can you say regarding this? The attitude and actions of group finance director, which indicates a lack of integrity should be discussed with the audit committee as the committee should be in the position to discuss the situation with him with the objective of making all necessary information available to the audit team. Okay. Then finally there appears to be over-reliance on a written representation. Reliance is good, but over-reliance from management. IIC 580. Now since I know the number I'm writing, if you don't know, you can see according to the relevant IIC. Written representation states that written representations should be used to support other audit evidence and are not sufficient evidence on their own. So did you get this point? Written representation is not an evidence on its own, but it will be needed to support with one more evidence. In itself, it cannot be trusted, because in writing, the management can give anything, because ultimately, if you see, management is a part of the organization. So obviously, they would always want the organization to be like very successful and all of that. So they can say anything, right? So that you cannot trust on their own, but they can be used to support other audit evidence. So in this situation, it appears that the representation is the only evidence which has been sought in regard to the likely success of the new project, or rather of the new product development, which is inappropriate. Then further evidence should be obtained to distinguish between research cost and development cost. As I told you, all the costs cannot be taken as development. There should be a distinguish between research cost and development cost. And to support whether the development cost meet the recognition criteria. Now this is a recurring question. Development cost should meet the recognition criteria as per intangible assets. So that is how they can be capitalized, otherwise they need to be expensed out. In IAS 38, intangible assets, and to confirm whether all of $6 lakh should be capitalized. What is the further evidence that you can obtain? Should be obtained, including a discussion with the project manager to obtain their view on a likely launch date for the new product, anticipated level of demand, and problems foreseen with completion of the project. This is the first further evidence that you should obtain. Then a further review of a sample of the costs included in the $6 lakh including evaluation of whether the costs are capital or revenue in nature. Then for a sample of costs, review purchase invoices and ensure that they are in the name the company to confirm the rights and obligations assertion of the capitalized cost. Then one more, results of any market research to support the assertion that the new product will generate future economic benefits. A discussion with the management to identify incurred development costs without carrying out research first. So without research first, how did you incur the development cost? And then in terms of trade receivables, what can you say? In respect of the development cost and trade receivables, right, or the sufficiency and appropriateness of evidence. Now development cost is done. Now in terms of trade receivables, sufficiency and appropriateness of audit evidence. So let's do that. The trade receivables is material to the group financial statements, and currently there is not sufficient appropriate audit evidence to determine whether the amount should remain recognized within current assets. The group financial statements could be materially misstated if any necessary reduction is available in value is not recognized. Okay. Then what else can you say for trade receivables? Agreeing the balance to invoices and order forms may provide evidence of existence, but it does not provide evidence on the recoverability of the balance. including the balance owed by handling company in the direct confirmation sample was appropriate given the materiality of the amount involved. But again, this would not indicate the recoverability of the balance even if Hamblin company had replied. So additional procedures would have always been required. Therefore, there does not appear to be appropriate audit evidence to confirm the valuation of trade receivables. Okay. So that is with a receivable. Now what is the additional evidence again that would need to be provided like we did here? This was the additional evidence, right, that we required. So similarly for receivables, what will be required? Discussing the situation with the credit controller will provide some relevant background information but on its own it is not sufficiently robust evidence to support the continued recognition of the balance. And therefore, what further evidence need to be obtained? Further evidence should be obtained, including for the evidence, any written correspondence between the group and Hamblin company indicating the measures which the group has taken to attempt to recover the debt and the response from Search public registers for evidence whether Hamlin Company has been placed in administration or receivership. This will indicate the need for an impairment review if it is listed, and or review of post-year-end cash receipts for any amounts received from Hamlin Company. So this is the answer that you will write for this. Now next we have is for 8 marks, which is using the information contained in Exhibit 2, critically appraise the extract from the proposed auditor's report of Goodman Group for the year ended 31 December 20x1, and you are not required to redraft the extracts from the auditor's report. So don't redraft, but critically appraise the extract. Okay. So for that, I'm giving you 2 minutes to just go through the draft auditor's report and see what you can say. That is the Exhibit 2. So Exhibit 2 starts from here. You have to go through this and the information below. So then I'll quickly check the comments. Okay. Please go through it. Please read the draft auditor's report. So now what have they asked us in part B? You know what is the meaning of critique? Criticize it, okay? Using the information contained in Exhibit 2, critically appraise the extract from the proposed auditor's report of the Goodman Group for the year ended 31 December 2024. You have to criticize the report. Critique. The entire report you have to criticize. So for that you have to start from the headings and structure of the report. Okay. So the audit work is now complete and the group auditor's report is due to be issued in the next few days. Materiality for the audit of the group financial statements has continued to be determined to be $4 lakh. You have been tasked with reviewing the draft auditor's report and the following supplementary information which has been prepared at the end of the audit. The audit partner has concluded that the fraud is immaterial and that all necessary work has been performed by the audit team. Further audit procedures were successfully performed on the development cost and the conclusion was reached by the audit team that the recognition of 6 lakh as an intangible asset is appropriate. A letter was received from Hamlin Company's administrators on 29 July 2025 stating that Hamlin Company is in liquidation and that its creators will receive a payment of 10% of outstanding balances. The audit team has concluded that $50,000 can remain recognized as a trade receivable and that $450,000 should be written off as recoverable. However, the group refuses to make any adjustments and the full 5 lakh remains recognized as a trade receivable in the final group financial statements. Draft Auditor's Report. Based on the above conclusions, the audit supervisor has drafted the auditor's report, which includes the following extract. Basis for opinion and opinion. Audit procedures indicate that trade receivables are overstated by 5 lakh. For this reason, we consider the group financial statements are likely to be materially misstated and do not fairly present in the financial position and performance of the group for the year ended 31 December 2024. Emphasis of matter. There are two matters to which we draw your attention. A fraud was discovered, as a result of which we have determined that $40,000 was stolen from the group. This does not impact the financial statement, but we wish to highlight the illegal activity which took place during the year. The group finance director obstructed our audit by refusing to allow access to audit evidence. He has also refused to adjust the financial statement in relation to the material misstatement of trade receivables, which led to the qualified audit opinion being issued. For this reason, we wish to resign as an auditor with immediate effect. So the auditor is resigning here. And we have to criticize the auditor's report, how the auditor's report can be better. So for headings and structure, what will you say? The report should not have the opinion and basis for opinion combined in one paragraph is the first thing, because we saw yesterday an independent auditor's report. वहाँ पे basis for opinion and basis for opinion were separate paragraphs, right? Title, addressee, opinion, basis for opinion, going concern issue, key audit matters, like that. You cannot club both. There has to be a format that needs to be followed, right? So the report should not have opinion and basis for opinion in one paragraph. The report should start with the opinion paragraph which is then followed by the basis for opinion. In addition to separating out the paragraphs, they should be given appropriate headings, like we saw in the independent auditor's report. Like when the opinion is modified, the heading should be used to denote the type of modification which is being made to the opinion. Okay, this is what you can do. Then what you can write in this case: the title, qualified opinion, seems most appropriate. The basis for opinion. Paragraph should be headed basis for qualified opinion, because now the opinion is qualified, so just not basis for opinion but basis for qualified opinion. Okay, then next you can write about the qualified opinion. The qualified opinion paragraph should be worded differently. When the opinion is modified, the following wording should be used. What wording? Except for the effects of the matters described, the basis in the basis for qualified opinion section. The accompanying financial statements present fairly in all material respects or give a true and fair view of. This should ideally be what you are supposed to write. This was regarding the qualified opinion. Now the draft opinion paragraph. Uses different wordings, and in particular using the phrase the financial statements are likely to be materially misstated does not indicate that a firm conclusion has been reached and could give users of the report some doubt as to the credibility of the auditor's opinion. Okay, now that qualified opinion paragraph is done. Now basis for qualified opinion also should be there. So next we have is basis for qualified opinion, because you have to make this paragraph, right? Because since you have a qualified opinion, you should have basis for qualified opinion paragraph. So this paragraph should contain further information on the reasons for the modification, including a description and quantification of the financial effects of the material misstatement. In this case, the paragraph should refer to the overstatement of trade receivables of $450 and the overstatement of profit by the same amount. Currently, the paragraph refers to an overstatement of $5 lakh, which contradicts the conclusion based on audit evidence. Ideally, this should be your basis for qualified opinion paragraph, which should be separate. And the last paragraph, which is this emphasis of matter, uska critique now we are going to give. So the next one we have is emphasis of matter. First of all, when it is used, an emphasis of matter paragraph is used when the auditor considers it necessary to draw users' attention. Emphasis of matter means what? To draw users' attention to matter which is of such importance that it is fundamental to users' understanding of the financial statement. The matter discussed in the EOM means emphasis of matter paragraph must be properly presented and disclosed in the financial statements. Okay. The draft auditor's report includes an emphasis of matter which is being used to discuss two matters. Neither of which are appropriate for inclusion in emphasis of matter paragraph. First, The emphasis of matter describes the fraud which has taken place during the year this matter is immaterial in monetary terms and therefore is not likely to be considered to be fundamental to users' understanding of the financial statements. In addition, it is not professional to highlight illegal activity in this way, and it could increase the risk of litigation from the group. As this amounts to breach of confidentiality. So these are the critiques of the auditor report. Critiques means how the auditor's report is wrong. So you're criticizing the report basically. Okay, so these are the critiques of the auditor's report. Please go through it. And that completes your second question. Now we take a break of 5 minutes and then we'll begin the third question. And the next question we have is life son. So again, a section B 25 marker question. These are the requirements. This is for 8 marks, sale and lease back. This is for 6 marks, investment property and shopping mall is for 6 marks. So 20, and this requirement is for 5 marks. So total 25. Okay. This is A part. And then the marks are already split between each issue, and this is the B part. Okay. Let's do the A part first and then do the B part. Comment on the matters to be considered and explain the audit evidence you would expect to find during your review of the audit working papers in respect of each issue described above. For each issue, you have to comment on the matter, explain the audit evidence you would expect during your review of audit working papers in respect of the issue described above. And for each transaction, the marks are split equally. So, Lifeson, it is 1 July 20x5. You are a manager in the audit department of Peart and Company, a firm of chartered certified accountants responsible for the audit of Lifeson Company for the year ended 31 March 20x5. Lifeson Company is an unlisted retail company which is a new audit client of your firm this year. The company's draft financial statements recognize profit before tax of $2.15 million, and last year the profit was $1.95 million, and total assets of $13.8 million, and last year it was $12.7. So you're doing great. The audit is nearly complete and you're reviewing the audit working papers. The audit supervisor has brought the following matters to your attention. So we'll do each matter, then write out about it, because the requirement says comment on the matters, consider and explain the audit evidence you would expect to find during your review of the audit working papers in respect of the issue described above. So one issue, then we'll write down. One issue, then we'll write down like that. The first issue worth 8 marks is the sale and leaseback transaction. On 31 March 20x5, Lifeson Company sold a property to a leasing company, Clive Company, for its fair value at this date. The property is situated in a sought-after area with a high demand for rental properties. For retail purposes, Clive Company has assessed the remaining life of the property to be in excess of 50 years, and under the terms of the sale agreement, Lifeson Company will lease the property back from Clive Company for a period of 10 years. Lifeson Company has treated the transaction as a sale and leaseback transaction in accordance with IFRS 16 leases and de-recognized the property in its financial statements and recorded a sales in accordance with IFRS 15 revenue from contracts with customers. Now, this is a sale and leaseback transaction they're saying, and we have to write down what extra things we would do. So this is third one, A part, first one. It is regarding sale and leaseback transactions. So it is regarding sale and leaseback transaction. So what can I say about the sale and leaseback transaction? First of all, I have to discuss the matters. I'll put, and below matters I'll put transfer of control. The auditor needs to consider the correct treatment of the sale and leaseback transaction required by IFRS 16 leases, which requires that an assessment should be performed based on the criteria specified in IFRS 15, which is revenue from contracts with customers. Okay, as to whether control of the asset has been retained by the seller or whether it has passed to the buyer. Then regarding the right of use asset, in this case the lease term of 10 years appears short compared to the assets remaining life, which is expected to exceed 50 years, and given the demand for retail properties for rent in the area. It seems likely that Clive Company will direct the use of land and obtain, not use of land, use of and obtain substantially all of the remaining benefits from the asset, including the potential cash flows in the future. That is regarding the life of use asset. In addition, it's not yet over. It should recognize a financial liability based on the present value of the lease payments and any gain arising on the transaction should be recognized in P&L for the year. Okay. In this case, the asset has been correctly de-recognized, but the auditor should investigate whether the company has recognized the right of use asset at the correct amount. So this is with the right of use asset, transfer of control, right of use asset. And now expected evidence. To be on file. What is the evidence expected to be on file? A copy of the sale and leaseback agreement reviewed to confirm the key details, including in particular rights of the lessee and the lessor to control the asset. Then what else evidence that you expect to be on the file? A working paper detailing all key aspects. Then what else? Agreement of the sales proceeds as per the sale agreement. Then what else? Notes of discussions with management. In relation to what? Transfer of control. And what are the evidence will you expect? A copy of client working papers. In relation to the calculation of right of use asset. Very important, a review of board minutes. And what else? A review of the local property market, including, I'll just give you one example, trade journals. What are other examples? Press articles, official statistics, etc. Okay, so this is what the evidence expected to be on the file is. You can also review the surveyor report, and I can say etc. Now the second one is in terms of In the same format, you have to write investment property. Now let's read about investment property. This is for 6 marks. Lifeson Company owns a building which it has used as a warehouse to store inventory. On 1 April 2004, the building, which had not suffered any historic impairments, had a carrying amount based on depreciated historic cost of $3,23,000 and a fair value of $3,48,000. On this date, Lifeson Company vacated the building and moved the inventory to new, larger premises. Management decided to keep the building in order to rent it out as a storage facility to local businesses and to benefit from any increase in property valuations. On 31 March 2005, the building had not been let and it had a fair value according to an external valuer of $3,53,000. The draft financial statement for the year recognized the building as an investment property at its carrying amount of $353 and including a fair value gain of $30,000 in profit before tax. Since reclassification as an investment property, depreciation has not been charged in relation to the building. For this same, you will start with matters. And in matters, the first one is materiality. So the carrying amount of the investment property represents how much percent of total asset. The investment property is 3,53,000 and total asset is 13.8 million. So that will give you 2.6%. 2.6% of Lifeson Company's total assets. At the reporting date, and is 2.6% of total assets is material to the financial statements. Now its classification as an investment property, shed a little light on that. The auditor should consider whether the requirements of investment property have been satisfied and confirm if the warehouse held by Lifespan Company is actually an investment property. IAS 40, that is investment property, defines an investment property as land and building held to earn rentals. If you've done SBR before this, you will know this by heart. Or for capital appreciation, or both. And even if you have not done, you've done FR at least. So that should be known. Lifeson Company's warehouse has been held to own rentals and for capital appreciation, and therefore qualifies as an investment property from this date. The fact that the property has not yet been let by the reporting date does not impact on this classification. Okay, then next what you can say about the fair value, right? The fair value, the warehouse is recognized at fair value of $353, and according to the relevant standard, which is say investment property, the fair value model is acceptable provided the treatment of any other investment property held by Lifeson is consistent. On transfer of an owner occupied property recognized at depreciated historical cost, which has not been previously charged impairment or impaired to investment property carried at fair value. IS 40, which is investment properties, requires that any resulting increase in the carrying amount should be recognized in OCI, other comprehensive income, as revaluation surplus within equity. Okay, and just like this, where you said evidence expected to be on file, what evidence will you expect? So write down evidence expected to be on file. What is the evidence that you're expecting? Notes of discussion with management to confirm its intention to hold the property, to own rentals, and for capital appreciation. Then inspection of title deeds held by Lifeson Company to confirm its ownership of the investment property. Then board minutes, very important for evidence of management discussion. The only way to understand and know about a management discussion is by reviewing the board minutes, because it's written exact what happens. Record the physical inspection of the building by the auditor in order to confirm its general condition. Agreement of the accounting policy to the notes to the financial statements, and then I can write etc. So this is my answer for the second category, that is investment property. Now the third category, that is the shopping mall, and for that I even have an extract, and it is for 6 marks. So next I have is the shopping mall. Lifeson company purchased a shopping mall on 1 April 20x3 for 9.5 million. At the date of purchase, the mall was estimated to have a remaining useful life of 20 years and a nil residual value. On 31 March 20x4, following an impairment review, the property was written down to its recoverable amount based on value in use of $8.25 million and an impairment loss of $775,000, which was recognized in the statement of P&L for the year ended 31 March 20x4. Lifeson company conducted a further impairment review as at 31 March 20x5, which indicated that the property's recoverable amount based on its value in use was now $8.85 million. As a result, Lifeson company has recognized an impairment reversal of $1.034 million in its profit before tax for the current year. The impairment reversal of $1.034 million has been calculated as its new recoverable amount of $8.85 million less its carrying amount of $7.816 million. The audit supervisor has prepared the following working papers, which summarizes the accounting transaction in relation to the shopping mall. So this is the transaction. Cost of the asset is 9.5. Depreciation for 20 years is this. Impairment is this. Then carrying amount at 31 March, that is the year end, is 8.250. Depreciation for the next year is 0.434. That gives you 7.816. That is 8.250 minus this will give you 7.816. And reversal of impairment of 1.034. At the year end you will get 8.850 because the reversal will be added. So based on this, what matters you will consider, explain the audit evidence, and what would you expect to find during your review of working papers. Again, the same format you need to follow. So this is the third one. So for asset impairment, you have to write materiality. So the carrying amount of the shopping mall represents how much of total assets? Total assets is 13.8 million, right? And the shopping mall is how much? Carrying amount of shopping mall is 8.85 million divided by 13 million will give you 64.1% of Lifeson company's total assets at the reporting date. And is therefore highly material to the company's financial statements. Okay. That is regarding the materiality. Now the next we have is regarding the value in use. The auditor should consider whether the client's calculation of the shopping mall's recoverable amount based on value in use is in line with the requirements of IAS 36, which is impairment of assets. Okay. This should include as an assessment of whether the client has used an appropriate discount factor. You use discount factor for calculating value in use, right? Based on the rate which reflects current market assessment of the time value of money and the risks specific to the asset. Okay. In line with IAS 36 definition of recoverable amount as the higher of its fair value less cost of sale and its value in use. The auditor should also consider whether the fair value less selling cost of the shopping mall exceeds its value in use. Okay, so this is what is in line with definition of IAS 36. Now next we have is the reversal of impairment loss. We have a reversal of impairment loss right here, 1.03. Reversal of impairment loss, IAS 36 requires that the increased carrying amount of an asset such as property attributable to the reversal of impairment loss should not exceed the carrying amount which would have been determined net of depreciation had no impairment loss been recognized for the asset in prior years. Okay, so that is about the reversal of impairment loss. Again, evidence expected to be on file. Agreement of the opening balances for the property to the non-current assets register as at 1st April 20x4 to confirm the correct amount has been brought forward in the client's working papers. Then next, physical inspection of the shopping mall property to confirm its condition. Occupancy level and to assess the reasonableness of the depreciation policy and forecast cash flows. Then copy of the client working papers for impairment review. Giving evidence. Then copy of the client's cash flow forecast. Then what else? Notes of discussions with the management, written representations, etc. So this is what is required. The next we have, which is for 5 marks, you have to discuss the implications for the auditor's report on the basis that no further adjustments have been made to the financial statement in relation to investment property or shopping malls. This is the B1 that we are writing. So let's read it first. Regarding this issue, okay? It is now 1 September 20x5 and the auditor's report on Lifeson Company's financial statements for the year ended 31 March 20x5 is due to be issued in the next few days. Following discussions with management, you are satisfied that the sale and leaseback transaction has been treated correctly and that you have gathered sufficient and appropriate audit evidence to support this treatment. However, management has indicated that they are not willing to make any further adjustments to the financial statements in relation to the investment property or shopping mall, and you are now considering the form and content of the auditor's report in relation to these matters. And for 5 marks, you have to write, discuss the implications for the auditor's report on the basis that no further adjustments have been made to the financial statements in relation to the investment property or shopping mall. So you have to write implications for the auditor's report. Implications for the auditor's report. Based on the analysis and discussion above, there are 2 misstatements in the financial statements in relation to the investment property and shopping mall. Which may have implications for the year's auditor's report. So about the investment property, what can you say? Lifeson company has recorded the increase in the carrying amount of $30,000 on the warehouse in the statement of P&L for the year. The increase in fair value of $25,000 on transfer of the property to investment property should have been recorded in OCI, and profits is therefore overstated by $25 in the year. This overstatement represents overstatement of 30 represents how much of the profit before tax? 1.2% of profit before tax, and therefore is immaterial, because for profit before tax is 5 to 10% or more, but this is 1.2, so it is immaterial in isolation, as this misstatement is immaterial. The audit opinion would not be needed to be modified, and it will be at the discretion management to make the adjustment, because it is immaterial. So the management can decide if they want to make the adjustment or not. Okay, if management intends to leave this as an uncorrected misstatement, written confirmation of its immaterial nature should be obtained via origin representation. Now this was regarding the investment property. Now for shopping mall. Shopping mall, what will you write? Lifeson company has incorrectly recognized the full pay impairment reversal of dollar. It was on point how much? 0.034 million in the P&L for the year. As per IAS 36, the reversal of an impairment loss should not exceed the carrying amount which would have been determined had no impairment loss been recognized based on depreciation over a 20-year useful life. The carrying amount of the asset should be capped at $8.550 million, and actually the reversal of impairment should be $8.550 minus $7.816, so that will be equal to $0.734. Assets and profit are currently overstated by $3 lakh. Representing how much? 2.2% of total assets if you calculate, and 14% of PBT, profit before tax, which is material because it's 0.5 to 1% of total assets and 5 to 10% of profit before tax, which is material to both. The statement of financial position and statement of P&L. So overall impact on the auditor's report will be what? The misstatement in relation to shopping mall is individually material, and if management fails to amend the FS, the auditor's opinion should be modified due to material but not pervasive misstatement. Of the shopping mall so the auditor's report should include a qualified except for opinion paragraph at the start of the report. This paragraph should be followed immediately by basis for qualified opinion, explaining reasons for opinion given. So this is the answer of the B part, implications on the auditor's report. Okay. Now we take a break of 5 minutes before we proceed to the last section B question that we have, which is the fourth one. Okay, so let's begin the next question, the last question of the lot. Mr. Again, you have to read the requirements first. This is for 10 marks. You have to critically again appraise the extract from the draft auditor's report. And the second part, the B part, is for 15 marks. So first let's read the A part. This is the A part. Critically appraise the extract from the draft auditor's report for the year ended 31 March 20x5. You are not required to redraft the extracts. Okay. It is 1 July 20x5. You are the manager responsible for the audit of Kilmister Company, a listed company specializing in the manufacture and installation of soundproof partitions for domestic and industrial buildings. You are currently reviewing the draft auditor's report on the company's financial statements for the year ended 31 March 20x5. Extracts from the draft auditor's report are shown below. Independent auditor's report to the shareholders and directors of Kilmister. Basis for opinion. Opinion is down, basis for opinion is up. We conducted an audit of Kilmister Company, the company in accordance with international standards on auditing IICS. Our responsibility under those standards are further described in the audit responsibilities for the audit of financial statement section of our report. We are independent of the company in accordance with the ethical requirements which are relevant to our audit of the financial statements in the jurisdiction in which the company operates. We have fulfilled our other ethical responsibilities in accordance with these requirements. We believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis of our opinion. The opinion is that we have audited the financial statements of Kilmister Company, the company which comprises the statement of financial position as at 31 March 20x5 and the statement of comprehensive income, statement of changes in equity and statement of cash flows for the year then ended and notes to the financial statements, including a summary of significant accounting policies. In our opinion, the accompanying financial statements present fairly in all material respects the financial position of the company as at 31 March 20x5 and of its financial performance and its cash flow for the year then ended in accordance with IFRS standards. Material uncertainty regarding going concern. The company is financed by a long-term loan from its bankers which is due for redemption in August 20x5. At the date of the auditor's report, the company is in the process of renegotiating the loan but has not yet reached a final agreement with its bankers. It's our view that the loan finance is essential to the continued survival of the company and that at the time of reporting, therefore, the absence of a finalized agreement represents a material uncertainty regarding going concern. The financial statements have been prepared on a going concern basis but do not make any reference to the loan redemption on the ongoing negotiations with the bank. As the external auditor, therefore, we are fulfilling our duty by bringing the matter to the attention of the users of the financial statements. What are the other information that are reported? The company's principal activity is the manufacture and installation of soundproof partitions for domestic and industrial buildings. The company therefore engages in long-term contracts which are incomplete at the reporting date and which are material to its revenue figure. The installation process is complex and significant judgment is applied in assessing the percentage of completeness which is applied to calculate the revenue for the year. The significance of this judgment requires us to disclose the issue as other information is relevant to the users of the financial statement. You have to critically appraise the extract from the auditor's report for the year ended 31 March 20x5. So the A part is the critical appraisal that they have asked us to do. So let's do the A part first. Okay. So first of all is the first point about critical appraisal is the presentation and structure of the auditor's report. Extract. The structure and format of the auditor's report is prescribed by the relevant international standards on auditing. The auditor's report should be addressed solely to the shareholders of the reporting entity and the title should not include any reference to the directors of Kilmister Company. In addition, the two paragraphs are presented. I told you there only that basis of opinion is up and opinion is down. The presentation is absolutely wrong. Are presented in incorrect order because we have seen the order of an independent auditor's report. The opinion paragraph should precede the basis for opinion paragraph. Then next we have is reference to ethical code. IIC 700 requires that in the basis for opinion, that is on which the opinion is based, paragraph, the auditor should identify the relevant ethical code, naming the IESBA, which is International Code of Ethics for Professional Accountants. The draft auditor's report does not specifically refer to the ethical code which has been applied during the audit and is therefore not in compliance with the requirements of IIC 700. Then next, material uncertainty regarding going concern. Regarding this, what you can say, the relevant standard on going concern provides guidance on how an auditor should report uncertainties regarding going concern in the auditor's report according to the relevant national standards on auditing of adequate disclosure about material uncertainty is not made in the financial statements. The auditor should express a qualified opinion or adverse opinion as appropriate. The use of uncertainty regarding going concern paragraph in the draft auditor's report is therefore incorrect. Okay, this paragraph should only be used when adequate disclosures has been made by the directors in the financial statements and would include cross reference to the disclosure. Given the disclosures has not been made, this is therefore not appropriate in this case. Then what should be done? If in the auditor's professional judgment the impact of this non-disclosure on the financial statements is material but not pervasive or qualified except for opinion should be issued. In this case, the opinion paragraph should be headed qualified opinion. And this should be followed immediately by what? Basis for qualified opinion. Paragraph. In addition, details of uncertainty regarding going concern should be given in the basis for qualified opinion paragraph. Then what about the long-term contracts? What should be done for the long-term contracts? And basically, first, what are long-term contracts? And where should it be disclosed? So the use of other information section in this context is inappropriate. This section should be used to describe the auditor's responsibility. For other information. And the outcome of fulfilling those responsibilities. But what should be done? Which matters to report and which matters not to report? How will you understand that? So in determining which matters to report, the auditor should take into account areas of significant auditor attention in performing the audit, including areas of higher assessed risk of material misstatement or significant risks identified then next, significant auditor judgments relating to areas of financial statements which involved significant management judgment. What judgment? Including accounting estimates. Then what else? The effect on the audit of significant events or transactions which occurred during the period. So the key audit matters section of the auditor's report should begin with introductory paragraphs explaining what a key audit matter is. And what else should the key audit matters explain? The KM section should then explain why this matter is considered to be a key audit matter, like why, due to the significant judgment involved in assessing the percentage completeness of the long-term contracts and the high risk of material misstatement associated with this judgment process. So this completes the A part of your question, which is critical appraisal of the extracts from the draft auditor's report, and this was the draft auditor's report. Okay, and the next we have is for 15 marks from the information provided above. Recommend the matters which should be included in Eddy and Company's report to those charged with governance and explain the reason for their inclusion. Your firm Eddy and Company has asked you to perform an independent review of the working papers of Taylor Company, which is a listed company and has been an audit client of your firm for the last 10 years. The audit field work is almost complete, and as a part of your review, you have been asked to advise the audit team on the drafting of their report to those charged with governance. Taylor Company is a discount food retailer which operates 85 stores nationally. The financial statement for the year ended 30th April 20x5 recognized revenue of $247 million, and last year it was 242. Profit before tax this year is 14.6, and last year it was 14.1, and the total assets was 535, and last year it was 321. So more than half has increased. As a period of rapid expansion, 20x5 has been a year in which Taylor Company has strengthened its existing position within the market and has not acquired any additional stores or businesses. The company's draft statement of financial position for 20x5 includes a property portfolio of $315 million, all of which are legally owned by the entity. In the current year, the company has chosen to adopt a policy of revaluing its property portfolio for the first time, and this is reflected in the draft figures for 20x5. The audit work on property, plant, and equipment, including testing a sample of the revaluations. AD & Company requested at the planning stage that independent external valuation reports should be made available to the audit team at the start of the final audit visit. A number of these documents were not available when requested, and it took 3 weeks for them to be received by the audit team. The audit working papers also identified that on review of the non-current assets register, there were 4 properties with a total carrying amount of $11.1 million, which had not yet been revalued and were still recorded at depreciated historic cost. The audit supervisor's review of Taylor Company's board minutes identified that the company has renovated car parking facilities at 17 of its stores, which has resulted in a significant increase in the customer numbers and revenue at each of these locations. The total cost of the renovation work was $13.2 million and has been included in operating expenses for the current year. The audit file includes a working paper recording discussion with management, which confirms that capital expenditure authorization forms had not been completed for this expenditure. You are aware that your firm had intended to replace the current engagement partner, Bryony Robertson, with Philip Campbell, who is Eddy Company's other specialist in food retail. Unfortunately, Mr. Campbell was taken ill earlier in the year and will not be available until next year's audit engagement. As a result, 20x5 in the INT 8th UK 6th consecutive year in which Bryony Robertson has acted as engagement partner. And for this information provided, what should be included in the report to those charged with governance? So let's do it. Report to those charged with governance. A report to those charged with governance is produced to communicate matters relating to the external audit to those who are ultimately responsible for the financial statements. The relevant international standards on auditing standard requires the auditor to communicate many matters, including independence and other ethical issues and the significant findings from the audit. In the case of Taylor Company, the matters to be communicated would include the following. So what all matters are there that you will communicate to those charged with governance? Revaluation of property portfolio, according to the relevant standard, the significant findings from the audit include auditors' views about significant qualitative aspects of the entity's accounting practices, including accounting policies and any circumstances which affect the form and content of the auditor's report. In the case of Taylor Company, the significant findings from the audit would relate to the changes in the accounting policy in relation to the revaluation of property and related material misstatements, and the following matters should be communicated. Then IS 16 PPE, that is property, plant and equipment, states that the revaluation policy should be consistent across a class of assets. And what else? The independent external valuation report requested by Eddy and Company at the planning stage were not available when requested by the auditor, and it took 3 weeks before they were received by the audit team. The auditor should report this delay to those charged with governance, detailing its impact on the efficiency of the audit process, together with any resulting increase in the audit fee. Then the next we have is the renovation of car parking facilities. So renovation of car parking facilities. About that, what can you say? The renovation expenditure on the car parking facilities at Taylor Company properties should be recognized as an asset according to IAS 16 PPE if it is probable that future economic benefits associated with the item will flow to the entity, and the cost of the item can be measured reliably. In Taylor Company's case, the cost has been quantified. What is the cost? 13.2 million, and it has already been derived economic benefits in form of a significant increase in customer numbers and revenue at each of these locations. The expenditure should therefore be capitalized, and its inclusion in operating expenses is not in compliance with IAS The incorrect application of IAS 16 and the material misstatement should be included in a report to those charged with governance as a significant finding from the audit which will impact on the form and content of the auditors to report. Then the audit working papers include minutes of discussion with management which confirm authorization had not been gained for this expenditure. The lack of authorization indicates lack of management oversight and a serious weakness in control which could allow fraud to occur. Furthermore, the lack of integrity shown by management in going ahead with the renovation works without the necessary permission is an example of management override. And could be indicative of the tone set through the organization. Okay. The report to those charged with governance should include full details on this significant deficiency in internal control and should include recommendations to management in order to reduce the associated business risk. Then next, what we have? Long association of audit partner. So that is the next. Long association of audit partner. Whenever there's a long association of audit partner, he was your audit partner for how many years? For the last 10 years. So what happens here? Familiarity threat. So the threat arises due to the long and potentially close relationship which he has with the staff of Taylor Company, leading to for being too sympathetic to their interests or too accepting of their work. This in turn gives rise to self-interest threat in that for long association and close relationship with the client create a professional, so to create a personal interest which may inappropriately influence a professional judgment or behavior. Then the code allows for an engagement partner to serve for an additional year if the required rotation is not possible due to unforeseen circumstances such as the illness of the intended engagement partner, in this case Mr. Campbell, right? So what will you do, Max, in these circumstances? safeguards should be applied, such as the independent review of the engagement, which is being performed, and this should be communicated to those charged with governance. So this completes the last part of the answer. With this, we complete the 4 questions of section B as promised. Okay. Tomorrow, we are going to do a mock on AAA. Okay, so please make sure you attend the lecture live, because now you might be on a study leave, so it might be very useful to do a mock, to understand a mock of how it should be done. And you should be doing at least 2 to 3 mocks before your real exam, so that will give you like an idea of how you should write things in the examination and how they should be done. Okay, so please go through the answer. A little bit of presentation also needs to be kept into mind. So the answer looks like nicely decorated, although you're not using colors because you don't have that much time, but you can just use a little bit of bold italics. If you have last 5 minutes, you can quickly go and then just do like this. Select it, for example. Just do it bold, then again you just go here. If you have like last 5 minutes left and you just want to a little bit of decoration here and there, you can always do it. So it looks a little presentable also. Okay. So that's it with today's session. Thank you so much for attending.